welcome to your Monday Futures Market Outlook for June 13th, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out eMiniSource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades. We plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that the market has gone through. When we bullishly crossed above that back in late 2009, we've now stayed above that 80-week moving average, including during the market correction in the summer of 2010. Really at this stage we were looking for some sort of a market top and subsequent market correction to come in, and just like clockwork, right off the level we've been looking for, it's happening as we speak. Now the one thing we want to emphasize is that there's no evidence that this is a new bear market just yet. That we know that there's some sort of short-term highs, and that could be intermediate highs or even longer-term highs. But as we approach this level right in here, around the 1200 level, if this was nothing but just a natural market correction before we begin another leg higher, we will find the market finding its lows over the next even 50-60 S&P points lower, and may even come sooner than that. Ultimately, if we have a short-term bottom in there and the market does a very good job recovering, then this may just become a big buying opportunity down in the zone. In the same regard, though, if we have a rally off of these this box, and if the rally fails and rolls over, if we get under that 80-week moving average, it may be the first indication that another leg of a bear market may be coming. Before we get into that speculation, recognize that a bear market probably will not signal until even August or September. So at this juncture, we just need to see how far the market goes on the short term and where the bounce goes from there. Just to review our key intermarket observations, like we were suggesting earlier, that there's not enough evidence for us to change our intermediate bullish bias on the market, but we do know that there's a second quarter high that's been put in place off of that target that we've been looking around the 1350, 1380 area, we now know that those are going to be the highs of the second quarter, but we're now looking to see whether that will be the highs of the third quarter or even the highs of the year. A lot of that will pan out over the next month or two when we see where this initial low comes in, and then subsequently the strength of any subsequent rallies we'll be observing. And a lot of that was oriented around the US dollar. The US dollar rally and a subsequent sell-off that had to retest its previous lows. If we do have a low in place for the dollar and subsequently a high in the euro, if the euro weakness comes in, particularly with weakness in some of those European countries, then if that US dollar bottoms in place, it will drive commodities particularly weaker. There's an increasing probability, and it's almost a certainty at this point, that we have seen the intermarket asset class rotation begin into the summer, where that was the theme being strong bonds, strong US dollar, weak commodities, and a weak stock market. We've been talking about that even from our 2011 market forecast, and it really is underway at this moment. When we take a look at that S&P 500 on a daily chart, you can see that the last 7-8 trading days have been very intense selling. At this juncture, we are going to look for a short-term S&P market bounce somewhere between the 1220 to 1260 area. We may even bounce off of the existing level that we're at, but at this stage we may even have a short-term blowout that even goes even as low as the 1220. One way or another, at some juncture, a low will probably come in, and it may come in as early as this week. When that comes in, we will probably begin a multi-month rally on the S&P that will probably work its way back up towards the 1300 level again. It will be that rally that will give us all the information we need to know whether this was a market correction or whether there's a much bigger and more ominous market decline coming, and so we'll watch for this bounce and where it goes. But so go into this week looking for a little bit further weakness and then probably a buying opportunity. Next year, when we take a look at the U.S. dollar, we can see that double bottom is looking like it may have formed. If this was a reversal breakout in the U.S. dollar, any subsequent follow through on that U.S. dollar to the upside should have a solid test up toward even as high as the 77, 77.50 area on the upside. That strength will roll most commodities over, and we'll talk about that as we see some of these other charts. Here, when we take a look at copper and where copper prices are, we were identifying this flagging formation that continued to find overhead resistance at the 420 level. At this stage, the flag is rolling over, and just like we were saying with that U.S. dollar, if the U.S. dollar breaks out on the upside, all these commodities will weaken, and this flag will officially have broken. And if that's the case, the measured move on the downside will have it going right down to 360, 370 on the downside during the corrective phase. Next year, I want to take a look at gold futures, and when we take a look at the rising wedge that we've been seeing here, it's shown some strength to come for a retest of its previous highs. It's one of the few commodities that isn't below its like 50-day moving average. But really, if the U.S. dollar in any way has sustained strength, gold will very naturally want to break this wedge to the downside, which would not only bring about a retest of its previous low around the 460 level, but also may have a move go as low as the 420, 440 area on the downside, where all the highs of October, November, December, and March came in. Next year, I want to take a look at silver, and silver is, we not only called the market top on silver and the subsequent correction, but we were suggesting that any market bounce on silver that failed in this 38 to 42 area would simply break down in this flagging formation and head right down to even the 26, 28, or 31 area on the downside. At this stage, you can see how it's rolling over. Again, any sustained strength in the U.S. dollar will have silver break this wedge and subsequently begin the decline lower. Next here we have a chart on crude oil, and the crude oil is a spitting image of silver, copper, all the same ones. Ultimately, we had a very sharp sell-off, subsequent consolidation for the last month, and now all of these flags are starting to get very toppy and rolling. All of these commodities are so hinged on that U.S. dollar. If that U.S. dollar breaks higher here and the euro weakens, we could see crude oil here make that leg lower on the downside and even test as low as not only the 91, 92 area where those highs came in January, February, but we could see even a move as low as $85 if that selling is done with any intensity. Finally, I want to look at the 30-year Treasury bonds, and we've been looking for the Treasury bonds to correct at some point, but rather than correcting downwards, they've been correcting sideways. It's a very interesting moment because if we don't see any legitimate a retracing move back down to the 122 area on the downside and subsequently continue to consolidate this way, any break above the 126 level on the upside could have these 30-year Treasury bonds gunning right up for the 129, 130 handle on the upside. We again, I don't have that target drawn up in here, but we don't necessarily always see market corrections in move downwards. They can sometimes move sideways like this. Again, I wouldn't be looking for that breakout to occur unless it actually breaks to new highs. So we'll be watching whether or not Treasury bonds can have follow through. That was your Monday Futures Market Outlook. Thank you for joining me.